So are we together, please? Sure, we are. So today we'll be going through chapter 4. You can just open your FA. We'll be using Icon Study Pack. I'm trying to share my screen. Okay. Yeah.
Hello, good evening, everyone. Our amiable lecturer, good evening.
Good evening, good evening.
Yeah, you're welcome. Good evening, good evening. Yeah. Mr. Tokman, please help us share the YouTube link to, you can share to me not to disturb our lecturer, 1. Number 2, please, for those that have their mic unmuted, Mr. Taiwo, we have a new lecturer in the house. I would appreciate if you can let's treat her to the best of our, what's it called? I want everyone to maintain decorum in this class. Please don't scare our sister, our tutor. Yeah, nice. So thank you for your time. We appreciate you and your time. So please permit me to leave this one. Miss Activity, you have the class now. Thank you. You're welcome.
So everyone will continue with today's class. And I believe last class, that was on Tuesday, Mr. Afis was taking accounting equation, right? So, my goodness. So, Mr. Sony, please, can you mute your mic? Mr. Sonny, please, can you mute your mic?
Okay, thank you.
Yes, sir. Thank you, sir. So on Tuesday, I saw Mr. Hafiz. I joined the class actually, and I heard him talking about you must have gotten to know assets equals to equity plus liability, right? And with that, if your assets is not equal to equity and liability, then your financial statement will not be balanced. So what does it mean to be balanced? Like your account to be balanced in financial accounting, it means that your credit side must be equal to what your debit side, right? If you have 5,000 on your debit side, then you must have 5,000 on your credit side soon, right? So that's just the basis. So for double entry bookkeeping, that's our chapter 4. So that's the topic for today majorly. So what's double entry? Like, if anybody just asks you, I believe everybody does not have our knowledge of accounting. We are just new to it. And let me just say that 50% of us don't have the knowledge of accounting because this is foundation level, right? And for people that have the knowledge, just bear with us. We are going to break it down for everybody to understand. So for double entry in financial accounting or accounting generally, what does that mean? Double entry means that if something happens to this person, it must happen to this person, vice versa. If something is happening to Taiwo, then it must happen to what Kehinde. Are we together? So this is what it's saying, that if you make a transaction in accounting, I'm just trying to break it down before we go through the notes. In accounting, it's not just that it goes to financial statements. You know that what we see online is a company financial statement, like their statement of financial position for the year ended, let's say 2024. Right, so we did not get to see the transaction, what occurred before we seen that financial statement. So in accounting, the first thing that happen is what is transaction. Transaction must occur before you will have your ledger, before you have your journal, before going to trial balance, before statement of our comprehensive income, that is our profit or loss, before you go into what balance sheet, that's financial statement, right? So what happened is what transaction. So from transaction, double entry occurs. Let's say that okay, Taiwo gave Mr. Kate Badmus 5,000. Something is leaving my side, right? So Taiwo gave Mr. K Badmus 5,000, right? What is the transaction? What has happened? Transaction has occurred, right? So transaction, if you have question, please ask me. There is a transaction between Taiwo and K Badmus. So how are we going to record this in accounting? So in accounting, you said one of the principle of double entry is what you debit the receiver and you credit the giver. You must have been hearing that term for a while, right? Debit the receiver and credit the giver. What is it saying? And don't look at it from the I was taking a class one day and the student asked that, but bank do send me credit once I put money in the bank, they will credit me. Don't look at it from that perspective. Bank, it's not that they use another account entirely, but what you are seeing is their own person, not from your own perspective, from their own perspective. They are preparing their account and they are giving it to you. So let's say now, for my example, Taiwo gave K Badmus 5,000. And I said, that is transaction in accounting. Something happened between Taiwo and K Badmus. Taiwo gave K Badmus 5,000, right? And we said that the principle of double entry is debits the receiver and credits the giver, right? So now, who is the giver? Taiwo, right? So what are you going to do? If you see something like that, Taiwo gave K Badmus 5,000. What are you going to do? What are you going to write out? Right? So you write it out, debit, and debit in accounting, we use DR as our debit. So debit Debit Taiwo, then you put 5,000 in front of it, or you do your TAFE format. You are still going to do all these things. Because Taiwo is giving Taiwo is the one giving money out. So you are going to debit Taiwo's account because she's giving sorry. We are going to debit Kate Badmus because what is receiving. We say debit the receiver. Are we together? If you have question, please ask me before we continue. So okay, thank you. Okay. So we said debit the receiver. Who is the receiver here? K Badmus. We are going to debit K Badmus account because it's receiving money. Who is the giver? Taiwo. We're going to credit Taiwo's account because Taiwo is giving out money. And you must have Mr. Afis must have taught you guys that asset accounts used to have a debit balance, right? And for liability we have a credit balance, and assets expenses we have a debit balance. I hope that is not new to you guys. You can just give some reaction if it's not new. And if it is new, let me know. Okay, it's not new. All right, thank you. Okay, thank you. So for equity to have a credit balance. So now what happened is Taiwo gave out money. Money is what? Money is what? To me now, I gave out money. Is an asset. Is negating my account, so I will credit my account, meaning that something is going out. So that is why I credit my own account. Now, cash that is going to K Badmus is receiving cash, and cash is what? Is an asset. Cash is coming in, so we debit the account. That means you have assets, and to me now, I did not have assets. Okay. Oh, so sorry. So what I'm trying to explain, Debbie, right? What I'm trying to explain is that principle of double entry. And I said that for principle of double entry, you debit the receiver and you credit the giver. I give out money. to K Badmus. Who is receiving? K Badmus. We debit K Badmus account, and we credit my own account because money is going out from my own account. And we said that assets, their asset as it was a debit entry, and from your accounting equation, cash is what is an asset, right? So you debit it, meaning you still have it in your account, right? And if your asset should have a credit balance, that means it's going out, you don't have it, right? So that is that. So let's continue with our class. Trying to split my screen, I don't know. So sorry for that. Okay, so I will not be grading all this so that we can speed up. So majorly what this thing is trying to, the grammar that they put here, what it's trying to explain is everything that I have explained. Principle of double entry, I said for every debit entry, you must have known that before too. Yes, in accounting equation, you must have mentioned it. For every debit entry, there must be what? There must be a credit entry. If something is going out, something is coming in somewhere. Do you get? If somebody is giving out, that means somebody is receiving. If a parent is giving, like you want a parent, you want to give your child like allowance, monthly allowance, you are giving out, but the money is going somewhere towards your child. Do you get now? So there must be a two transaction, two leg must occur in a transaction. Somebody is giving, somebody is receiving, right? So they said that, oh, we are seeing my screen. So sorry, are we? Yeah, sure. Thank you. So there's no exceptions to this rule, and that is what this the text, the study pack is just trying to explain, that for every debit entry there must be what? There must be a credit entry. So all transactions are analyzed into different types and then recorded in what? In series of individual record called accounts. So all these accounts now, what this place is trying to say is, I said that you record it in Taiwo's account, K Badmus account. Taiwo is giving money out, K Badmus is receiving money. So all these things, all these transactions that we analyze into two, we analyze it into what? Taiwo, that is personal account. So we still get there. That's chapter 5. That's prime entry. We are going to have real accounts, nominal accounts, personal accounts. We are still going to get there. But now what we are trying to get is the double entry principle. So Taiwo and K Badmus now, they are what? Personal accounts, right? So from the transaction, Taiwo gave K Badmus 5,000. So the account involved is what? K Badmus, Taiwo. So this transaction, we analyze it into what? Into accounts. We analyze it into what? Into accounts. And the accounts, based on our example, we said Taiwo and Kate Badmus. That is the account involved. Did we all get it? And the accounts now, one of it is what? If you are going to post it into a trial balance now, Taiwo account will be what? A liability, because it's what? Is having a credit balance. And K Badmus is having what? A debit balance. That is an asset. So when we want to prepare our trial balance, let's just see that we want to balance up our accounts, of which we are still going to do now. We still have a long way that we are going, but just chill. It's not something that is hard. Account is very, very simple. Once you've gotten the principle, this double entry principle, then we'll start building on it. It's not that hard. Do we all get it now? Okay, thank you. So let's continue. So all this, so now this I said Taiwo account and K Badmus account. So Taiwo account and K Badmus account is what? That is ledger. We used to call it ledger because we open what C format. I don't know if I can open this now order. So sorry. Hold on, please. Let me see. Okay, thank you. So let's just continue with this. Then I'll continue with what I want to do later. So that I said Taiwo and K Badmos, we call it a ledger account. A ledger account in the sense that, remember I said that this transaction, something comes out of it. You call it what? Accounts. They analyze
Sorry, I lost connection. I can't hear anything. Am I the only one?
Same here.
I
Hello, good
can't
evening,
hear
everyone.
anything.
you're not the
Hello, good
only
evening,
one.
everyone.
You're not alone, no.
Hello, good evening, everyone. Can you hear me?
Good evening,
Yes, good
sir. Loud
evening,
and
sir.
clear.
Yeah, good
Good
evening.
evening, sir.
Sorry, we all understand how Nigerian network can be sometimes. I think your tutor just lost her network. Please just bear with. She'll be back. I'll try and reach out to her now. Hmm? Yeah, sorry for that.
Sir. Thank you, sir. so sorry. I'm so sorry. It's my network. I'm so sorry. Please forgive me. So, can we continue now? I'm so sorry. Let me share my screen.
You're welcome.
Yeah, thank you. Try to share my screen. So I'm trying to share my screen so we can just continue from there. FA. Okay. Okay. Okay, so nice. So where are we? So I said accounts. The two accounts are called what? Ledgers accounts. So that's just the primary thing. So they are called ledgers. So we'll be using ledgers to demonstrate our accounting entry for the purpose of this class. Then next class we can go into cash book and other primes entry. Right. So as I was trying to explain the other time that we have general ledger, we have general ledger is also known as nominal ledger or main ledger. Then we have personal ledger, we have real that has to do with assets and the likes. We have personal that has to do with accounts of people, person, K Badmus account, Taiwo's account and the likes like that. Do we get then real accounts, all these assets accounts. So that's all those accounts. Then we are going to deal with all those ones when we get to, is it this class? No, it's not it. Maybe next class. Or Mr. Hafiz must have mentioned it when he was doing the introductory class. Right. Yes. So next testing. So let's just I have mentioned this overview of accounting. I said transaction, book of prime entry. That is chapter 5. Book of prime entry. You have to be doing sales day book, purchase day book, return inward, return outward, and the likes like that. So we'll do that on maybe Thursday or next week probably. Then accounting ledger. This is what we want to do today. Then from ledger, we go to what? We go to our trial balance, of which we are going to do that today also. Then financial statement probably today. So trial balance is will let us know maybe what you have entered is actually correct. The transaction you have processed maybe is what is actually correct. Now you said that okay, Taiwo give K Badmus what? Give K Badmus 5K, and you have what? You have debit K Badmus and you credit Taiwo's account. Trial balance will tell us, is these things what? Is it correct? What you have entered, the transaction, the accounting entry you have entered, your double entry, is it correct? So is what is trial balance that will shows that it will let us know, okay, this thing that you have done is actually correct. So it's the one that will show that okay, debit side is equals to what credit side. You can't know that in your ledger account, no. But your trial balance it actually shows that okay, this is correct. What you did here is correct, and the likes like that. If you have question, you can unmute your mic and just let me know. Then, so
Sorry, I want to ask, in the screen you showed, we have from
okay,
transaction to book or books of prime. I don't
yeah.
know which one is book of prime entry. I want to know.
Yes, I said that is for what for next week. I said book of prime entries. We have sales day book, we have purchase day book, we have returning word day book, cash book is also part of it. We have journals. So we'll deal with that in the next, it is chapter 5, maybe next class or so. We're going to deal with that. Are we clear?
Yes, ma'am. Thank you.
All right. So, so the basic rule, I've mentioned that one. So all these things we are going to be okay, FA.
Sorry, I can't see your screen. I don't know if it's just me.
Okay.
It's your network. It's your network.
Oh, so sorry.
No, not you, not the handcuff, not the
Okay,
host,
it's
please.
FA, right? Okay, okay.
Yes,
Just
yes.
check your network, please.
She might try to go out, then come in again.
All right, thank you. So now for the basic rule of double entry bookkeeping is what I've been explaining since. For every transaction is recorded twice, right? Every transaction you record it twice. What is going out, what is coming in, which account is involved. That is just one thing about accounting. Okay, Taiwo is giving out money to K Badmus. Who is giving out money? Taiwo. Who is receiving the money? K Badmus. Right? So two accounts is involved. For every transaction is what is recorded twice. And in ICANN, before so that after in your exam, you now be say, okay, our study did not teach us this one. No, it's not like that. In a question, maybe the number it's 1, 2, 3, 4, like that for the equation they give to you. Questions they might just put it and you have like 5 transactions and you just have to break it down. They might ask you that Mr. Ade borrowed loan. After borrowing the loan, they will not tell you after borrowing the loan. No. Mr. Ade borrows loan to buy what? To purchase a motor vehicle. First thing, what happens is what the person, Mr. Ade what? Mr. Ade borrows what? Borrows money. Mr. Ade borrows money to what? Use the money he borrowed to do what? To purchase a motor vehicle. Right? So first thing now, from that transaction now, Mr. Ade took a loan, right? To purchase motor vehicle. First thing now, you see that he took loan. Loan is involved. Purchases is involved. Motor vehicle is involved. I don't know, maybe we are getting what I'm trying to say. Mr. Ade took loan to purchase motor vehicle. Before he purchased the motor vehicle, what happened? He took a loan, right? So two accounts is involved. That means he took a loan to do what? So, and remember I said you do what? You debit the receiver and credit the giver. He is giving out loan, you debit loan and you what? Credit what? What is coming in? Money is coming into the bank, right? So we're going to try out some questions and you're going to see it. Guys, I think yes, we have it in the question. So every transaction must be recorded twice: debit entry and what's credit entry. And in accounting, the debit entry is always left. Yes, it's always left side, and the credit entry is always what's right side. You can see my screen here. And I've said it so that the total, everything must be must give the same answer. What you get at the end of the day must be equal to the same thing. So this is the account now. See the debit side here. And I said that DR represents debit and CR represents what's credit, right? So credit side is credit, is the right hand side. Then debit, okay. Okay, Mr. You can.
It's a miss, ma'am, woman. Please, I want to ask. You said that the total must be the same.
Yeah.
I want to understand is the total from debit side and the credit side must be the same. Is that
Yes.
what you're trying to say?
Yes. Yes, that's what I'm trying to say.
All right.
We are going to demonstrate
All
that,
right.
and you're going to get it. Don't worry. You're going to demonstrate that.
All right.
Yeah. So this is the account. Now I said debit side on the left side, then credit side. And Mr. Hafiz have also mentioned that your assets, you've all gotten those things. Assets, debit side, expenses, debit side. Income, please, you can mute your mic now. Mr. Gbenga, do you have question?
Yeah. Good evening. I have a question.
Okay, you can ask your question.
Yeah, the area of confusion in this accounting stuff is that this debit side and credit side. I want to ask because sometimes when you want to post, either when you are
Sorry,
doing.
Mr. Gbenga, I can't hear you. Maybe you should type it. I can't hear you.
Okay.
Or you change your background where you are. Okay. So I don't know what is trying to ask. So for credit side, I said credit the what? The giver, right? Credit the giver and debit the receiver. Based on the example, I said Mr. Taiwo gave Mr. K Badmouse 5K. Money is going out of my account. So what do? The giver. That was the giver. You do what? You credit my account. The receiver is who is getting the money. K Badmus. Then you debit it. You debit what comes in. What is coming in? That's another way to see it. You debit what is coming in and you credit what is going out. Now look at for Taiwo now. Money is going out. That is why we have to credit Taiwo. For K Badmus now, money is coming in, then we debit K Badmus. I think that is clear, right? I guess so. So alternative for ledger, it is what? It's usually T format. You see the T format, right? So it's usually T format, you debit and you credit. And I'm going to demonstrate that. I don't know if you can see this. Okay. Let's just continue. Okay. I've mentioned all these things too before. This is okay to 9, right? See after. So rules of debit and credit. So for account, now I've mentioned it before that your assets in Taiwan now, if in my account, if I have money before, money is going out. So that is what is a decrease, right? For Taiwan is a decrease. Is a decrease in my account. For K Badmos is an increase. So this is debit side. This is credit side. I don't know, maybe you can see the arrow. So record as a what? Record as a debit entry. Increase in assets. If your asset is increasing, for K Badmos now, money is coming in, meaning what? More assets to him, more cash. Cash is coming in. Or you receive an alert in his bank. So that is what is an increase. So you debit it. An increase in an expenses. If your expenses is increasing, you debit your expense account. Let's say now you are you debit it. If you are going to work, right? Let's say I'm going to work. I bought what's the next point I can use? Bought I don't want to use one. What can I buy? What can I buy? Let's say I bought biscuits, but biscuit is a petty expenses. But I just want to use that. Or let me say I bought a clothes. It's a petty expenses too. But then let's use a clothes now. If I bought a gown while going to work, what is that? Money is going out of my account, right? So I'm going to debit the expense account. So that is what this one is saying. This increase in expense, this increase in expense that you can see in this place, this one that I highlighted. Increase in expense is saying that when you bought something, when you are going to work, oh my goodness, did I stop that? I'm so sorry. Okay, so sorry for that. So if I'm going to work, and I bought a gown, right? So this is saying that I'm going to debit my expense account. What is the expense? It is gown. I bought a gown. That is what purchase is, because a gown now is not really an asset. So we categorize it as what a purchase is, a purchase. So you purchase a gown. So you debit the expense account. Did we get it now? So it's an increase in expenses. We debit it. What happened to my own account like that? Taiwo that bought the gown, you credit my account because I'm giving out. What is receiving my money? Gown. I bought gown. Is it clear?
It's not clear.
Okay, thank you, Eniola. So this is what I'm saying. Did you get the example I gave, Taiwo and Kebadmo? Did you get that one? Please, I need your response, Eniola.
Yes, I'm with you.
Did you get Kebadmo's and Taiwo's example? Did you get that one?
No, I did not get.
I said, okay, let's say Taiwo gave Kebadmo's 5,000, right? Please, you can unmute some mic and just answer me. Yes. Okay, so please giving money out.
Taiwo.
Please receiving the money.
Badmus.
So what is the principle of double entry?
You said debit the receiver while you credit the giver.
Yeah. So who is the receiver?
That's Badmus.
Who is the giver?
Taiwo.
Yeah. So that's that, right?
Okay.
Is that one clear now?
Yes.
Yeah. So the second example I gave is that I'm going to work. So for this one now is the example that we just finished now is what for Badmus is an increase in what in assets, because he received what cash, and cash is what cash is an asset, right?
Yes. Yes.
Yeah. Yes. So for Taiwo now, reduction, you can call it reduction in what in assets. So that is what is in credit side. If you see record as a credit entry, a reduction in an asset, because I'm giving cash out to Badmus. Do we get it now?
Yes, I get it now.
Okay, so for the second one, increase in expenses. If I'm going to work and I see a nice guy, a nice gown, Victor, please, I'm coming. If I see a nice gown, right, and I was like, I love this gown, I need to buy it, and I bought a gown, what is the transaction that is involved? Taiwo and gown, right?
Yes.
But the gown now is not an asset, is what an expenses, right?
Yes.
So we said that an increase in expenses was you debit it, right? Even though before we said that an increase in expenses you debit it, who is receiving money now? Okay, I bought gown of 25,000 naira. Who is giving money out? Taiwo. Who is receiving the money? Gown is receiving the money. The person selling the gown. I bought gown. So gown is taking my money, right?
Yes.
So you debit expenses account, which is gown, and you credit Taiwo's account. Is it clear?
Yes, it's clear.
If it's not clear, let me know. I know it can be a bit confusing, but then the more we solve questions, the more it becomes more clear.
Yes, it's clear, but you mentioned something around purchases accounts.
Yes. So I said now, the best way to record it is that this is how they are going to put it for you. Taiwo purchased a gun for cash, 25,000 naira. That is how they will put the transaction for you. I said the first leg of account is what transaction. And what is the transaction? Taiwo purchased a gun of 25,000 naira for cash. The for cash there is telling you that is a cash, I paid cash. So now it said Taiwo purchased gown. So because gown now in your accounts for a company, a business owner, a gown is not a what? Is not an asset. Did you agree with me that it's not an asset? So yeah, it's not an asset. So we categorize it. The best way is to put it under what? Purchases, debit purchases account, right? Is it clear? Is it clear now? Thank you. So thank you. Then we can go to welcome. Mr. Victor, do you still have question?
Yes, I
guess
do, but I guess you've not gotten the aspect of a reduction in a liability on the debit
so. We
side.
get there.
How is okay?
We'll get there. So if I explain that you don't understand, so you can ask me later. Thank you. So a reduction in a liability. So before we get to this reduction in liability, let's go to the credit side. Record as a credit entry, a reduction in an asset. And I've explained that for Taiwo now, Taiwo is giving out what cash to Kate Badmus. For me now is a reduction in asset because I'm giving a cash out, and cash is what is an asset. So for Taiwo now, I'm going to record this what as well a credit entry. So all these things, they just trying to break the debit the receiver and debit the giver. They're just trying to break it down for us from every angle of transaction that you might have. Right? So the data that now a reduction in an asset for Taiwo now, Taiwo gave K Badmus 5,000 naira cash. So my own cash is reducing. So that is what a reduction in an asset. I will say what you credit the giver, Taiwo. That's why I have to credit Taiwo's account because what my asset is reducing, my cash is reducing, right? So a reduction in an expenses. How can your expenses reduced? Who can give me an example? Let me think of an example of a reduction in expenses. Let me say I bought. Okay, let me say I bought. If I bought this thing, I will do that. I can't think of an example right now. A reduction in expenses. Can I think of Olamide?
Okay, I think maybe if someone bought something and you later sell it out, I think I don't know how if that is true. But I'm just thinking that it may be an reduction in expenses.
Okay, you are trying to say that if I bought something from you and I've
Yes,
paid, but you've not given it to me.
I say if you bought something now and later on you feel that okay, let me resell this thing back after a while.
Mm, not really. That one now is a sales. If you sell it back, is a sales. Right? Is a
Okay.
sales. So let's just say like reduction in your expenses is okay. What of discounts given to it? Yes, thank you. Let's say I give out discount the normal price. Not really. Eniola Ajayi. Okay, are you trying to say something? And Victor.
Yes,
Okay, Eniola first.
yes. I wanted to give an example.
Okay.
So, for instance, purchased laptop
Mm.
cash. Can you
I
hear me?
can't. Yes, I can hear you now.
Yes, I said purchased laptop paid by
Yeah.
cash.
Okay. You know that if you purchase laptop paid by cash, that is increase in expenses. It is what is an increase in expenses. What are the ways in which your expenses can reduce? Is like I don't know if like you return part of your expenses now. Let me see. Someone mentioned that. Let's say that you bought 2 pairs of let me say what is that? You bought a carton of Indomie, right? You felt like why 2 carton of Indomie? Yes, return at all. Thank you. Receivables. Is it receivables? No, receivable is what is an asset. So
Yeah.
so for return now, you bought 2 cartons of Indomie, right? And you felt like why did I buy 2 cartons? Let me just return uh 2 part of it, one of it, right? I bought a car, but since I'm paying by credit, I'll check that. So that's another example. Someone is giving another example there for them.
What about
So
payables?
payable is a what is a liability. So we are still going to get there. I love the example that you guys are giving, But then, in accounting, we are still going to get to a chart of account. Receivables, like a debtor now. You are saying that if somebody is owing you, right? Like you sell something on credit, that's receivable. Like you sold, let's say I bought laptop from you, sold laptop to me. You are the one that initiates the sales. You sold to me on credit. I've not paid to you. That is what credit sales. That is what you're expecting to receive from me. Do you get? That is receivable. For payable now, in my own account to be payable. Like somebody wants to pay, right? Somebody is you are owing somebody, your supplier. So let's look at it from your own perspective, Eniola. If you sold to somebody, your customer, if your customer they bought on credit from you and they are owing you, so that means it is receivable. Yeah, you want to receive from them, right? But for your supplier, you are getting your goods from someone now, and you bought on credit from your supplier, right? So that is payable. You bought on credit from your supplier, you will pay your supplier now, right? Later. So you want to pay your supplier, that is payable. But your customers want to pay you. Somebody is owing you, you are owing somebody. The people you are owing, the owner of the vendor, they are what? Your payables. And your receivable is your customer owing you. So receivable is an asset because people want to give you money. Money will still come into you, but you now is a liability to you. You still want to pay people. It's not like expenses. Ekene or where's Ekene? Do you want to say something? Okay, we can continue, please.
Yes, I want. I was trying to unmute myself.
Okay.
So you're asking of examples of expenses, reduction in expenses. Something that came to my mind is, for instance, in a business, if you want to reduce expenses, for instance, electricity, maybe one of the ways we can reduce expenses is by, if it's a company that is using like electricity unit. So one of the ways could be to install solar system. That's, we are reducing expenses, and then maybe reduction in salary, maybe where a company lays off some staff, in that way they would have reduced the salary expenses.
Yeah. Okay, thank you so much. Actually makes sense. So we are still going to break it down. John, you raised your hand. Did John want to say something? Oh, peace. You can just talk since I'm not hearing anything from John.
Okay, I just want to be very clear. Okay, from what I understand here, you're trying to say that payable is a liability, and receivable is an asset, right?
Yes.
Okay, now I understand. Thank you.
You're welcome. We are still going to get there, and you are going to understand better when we get to our financial statement. You are still going to understand that very better, very clearly. Mr. Victor Balogun, you want to say something?
Yes, ma. I just want to get you right. So, in the aspect of the credit side, a reduction in an asset, maybe if my example is correct, please let me know so I'll be able to understand it better. When you reduce an asset, that is giving out cash, because cash is an asset. And when you are reducing an expenses, meaning you are paying for maybe a rent, electricity bills, is that what you are trying to say?
No. It's, that expenses now, increase in expenses means that you are incurring more expenses. You are giving out more money. Like you are buying, like you bought a biscuit in the morning, in the afternoon you buy another one. That is an increase. Money is going out. It's an expense. Expenses means that something that you cannot capitalize, something that you cannot, it does not really make sense, like a financial sense. Like now, that you owe a car, Can you compare a car to food? Food is not really an asset. So you can say that food is an expenses. A car and a junks that you want to eat while going to work is a two different thing. So assets now, the increase in assets is that okay, cash. We say cash is a what? Like in accounting, you're still going to get there. We call it current assets. It's an asset. It's asset that you can use now. Cash is what? Is a what? Is a current asset. But expenses, like you just bought this thing, just want to consume it. It has value, but not really like that. I don't know, maybe you get what I'm trying to say, Mr. Is it Victor?
Yes, ma'am.
Okay. So for increase in expenses is that you are incurring more expenses. You are incurring more expenses. It's just vice versa. Do you get it?
Yes, I get the debit side.
So the reduction is like maybe your expenses is reducing. Let's say maybe you bought something on credit and now I don't know. You still see example to illustrate it better. Maybe the example we are going to solve now. You see the example and you're going to understand better. So as I don't know, do you understand now? You can still cite your example, but then time is not on our side. Are you clear, Mr. Victor?
Yes, I'm getting it.
Okay, thank you. So let's move forward. So for reduction, reduction in expenses, you've cleared that one. So reduction in the liability is saying that I said liability payables, right? So I said payable is what is a liability. We call it current liability. So in financial statements, we have assets, then assets is divided into non-current and current. Then liability, so we have non-current liability and current liability. Don't worry, you are still going to get there. So for payables now, somebody mentioned payables the other time, and I said payable is what is a liability, is a current liability. Payable in the sense that you want to pay your supplier, you've gotten some stock inventory from your supplier, like people that used to order now. So your supplier has supplied you goods, but you've not paid. So you are owing somebody. Anything you are owing is payable. You are anticipating to pay it. So it is what? It is called payable. Do you get now? So for Eniola now, you ordered something from your supplier and you have not paid. That is called that is payable, right? That is payable. So for reduction in the liability, you debit it. So this is it. You said debit. This is, you still come back to that debit the receiver. Debit the receiver and do what? Credit the giver. Credit the giver, right? So for your payables now, let's say you want to pay your supplier. What is the payable that you have? You are owing your supplier, let's say 100K. You are owing your supplier. That is what is in your payable, the amount you are owing your supplier. Now, when you pay your supplier now, your supplier, you don't know the name of your supplier now. So we put it in payable. Payable. Who are you paying? Your supplier. It's called payable. The amount you are owing, payable. Payable is what? 100K. You are owing. Amount you are owing is called payable. Payable is how much? 100K. So that 100K now payable, you want to pay it to that person you are owing, and you now pay 50K out of it. That is called reduction in liability. So when you pay this now, you debit what? You debit payable. That is liability. That is why it is on what? On the debit side. A reduction in liability, you debit it because you are what? Payable is receiving money from you, and you now credit what? Where are you giving it? Is it cash you are paying to your payable? Is it a bank? So let's say now from your own, you are the owner of the two accounts, but you will not see it from the perspective of what? Eniola payable. Eniola is owing his supplier, 100K, And I said that 100K in accounting is called payable. Owing, you're owing somebody, your supplier, 100K. It's called payable. And this payable, now you want it to reduce in your account, in your in the phase of your account, your liability, you want it to reduce. I said, okay, you just decide in it, let me pay this person. Out of this 100K that I'm owing, let me pay 50K. So the 50K you want to pay now, what transaction is occurring? What is the transaction now? How are we going to record this? So this is Eniola. It is not going to be Eniola because Eniola Eniola can be a business owner, but how do we undo it? The transaction is between either cash or bank. It's either you are paying cash or you are paying check. So if you are paying check, it will be bank. If you are paying cash, it will be cash. So it will be between cash and payable. So cash and payable. Now, who is receiving the money? Payable. Believe me, it's still within our account too. But payable now, we are settling our payable and cash is going out. So that's why we said that reduction in what? In liability. I'm saying that payable is a liability, right? So our payable is reducing from 100 to what? So 50K. Is it clear? So who is the receiver? Payable is receiving money, is receiving this cash. And cash, our cash account is giving out the giver. We credit cash account, we debit payable because it's receiving the money. Is it clear? Yeah. If you have question, you can ask now before we go to the other one. Thank you, Mr. Michael. Yeah, thank you. Thank you, everyone. So reduction in income. Let's say income. If your income is reducing, let's say the amount you are sales, can I say sales? If your sales is reducing, like you make a sales to somebody, returning word. So that's another one, returning word. If you sold something to me, you make a sales to me, sell something to me now. And I said, no, I don't want it again. You sold something to me, it's an income to you before, you have received your money, you make a sales, you sell something to me, 50K. And I came back to your shop that this gown, you sold 2 gowns, and I don't like the second one. I want to return 1 out of 2. You have to return what amount of 25K to me. Let's say the pay of it is just 25K per one. So your sales from that one is reducing. So that is returning what your sales reduce because you have record that okay, you make a sales of 50K before, but now they return 1. Did you get? Though that one that they return now, it's returned back to your inventory, but something has happened to your income. Your income has reduced. So that is about a reduction in income. Then reduction in capital, drawing. So what can make your capital to reduce is drawing. Let's say Pelumi, is it Pelumi Eniola? Sorry. So let's say Eniola is the owner of this Eniola business. Let's just use that one. So Eniola is the owner of this venture, and let's say at the end of the year, total profit as owner of the business, let's say is 1 something billion, and just like as the owner of this business, let me feel good, let me do 30 December, and you just withdraw 500K from your business account. So the 500K that you withdraw is called what? Drawing. You draw it out from your business account to your personal account just for your own personal needs. So that means a reduction in your capital because something has reduced. Your business money has reduced. So in accounting, it is called drawing. You can see Mr. Kinikon, they can give you transaction and you just say Mr. Kinikon withdrew this for personal use, take assets. Like, okay, let's say that part of the inventory that she's selling now, December has come and she's selling clothes, and she just said that let me just take 1 cloth and use it as my December this thing. So it's an inventory, you take 1 cloth. So that one too is a what? Is a withdrawal, is a drawing. You draw it, but that amount now, it will not be what? It will not be cash, it is inventory. It is an item that you took from your distance, not cash. So that is what a reduction in what in capital, and it is called drawing. So the other side is increase in liability. Is still our payable. When you're owing more, your supplier, you are still owing your supplier. You bought on credit from your supplier. Hello, supplier, please, I need this. Send it to me. I'll pay you next month. Another one, you order more. And you're owing. When your owing is increasing, your debt is increasing. So that is what the increase in liability. You credit your account and you debit the account of who you are owing. The increase in income, so your income, your let's say you make a sales, okay, this is your August 1st girlfriend day, right? And a cake vendor, right? This the sales will be what will be like to be massive. So increase the what increase in income. In your I'm coming. So increase in income. Let's say tomorrow now a cake vendor, like a cake someone into a cake this thing will actually make sales. This income will increase because what it will make huge amount of sales. People will be ordering cake based on what on the first tip that is happening tomorrow. Okay, ordering cake. So the income will increase because people are what they are purchasing from her, right? So that is increase in income. Eniola, you can ask your question.
Okay, so I wanted to ask question regarding the example you
Okay.
gave around income.
Okay.
So you said, for example, if you purchase, I've forgotten the material you mentioned, or if you purchased it and then you returned it back. So I
Mm.
wanted to ask what would be the name of the other account that will be credited?
Okay. This reduction in our income, right?
Yes.
Let's say I bought 2 pairs of clothes from you, and I came back to your shop, and I said, "Ma, I telling me I don't like this clothes that you sold to me. Can I return one?" Then I returned, and you sold the two to me for 50K, and you said, okay, the second one will cost me 25K, right? So I will, okay, can you refund the money back to me, and I'll return your clothes to you, right? And believe me now, you will have thought I'll make at least 50K today now. Okay, I've sold 2 pairs of my clothes, and I'll make my income is what 50K. So that is a reduction. Now, when I came back to your shop, I returned one clothes and you gave 25K to me. Your income reduced, right? Is it clear?
Yes, it's good.
Thank you. So for capital, increase in capital now. For increase in capital, you said we'll credit the account abi. Why? Money is what? For increase in capital, let's say you introduce, okay, you want to expand your business. You just say, okay, for my salary account, let me just put 1 million to my business account. That is what an increase in capital for your business account. You introduce 1 million. So what are you going to use? So now, but let me from your salary account, you say, okay, oh, your daddy just gave you 1 million for you to add to your business. Your business now is receiving, Abby. Is that not it? Increase in your capital. Are we together? So increase in your, is it increase in capital? So your capital now, your capital increase, maybe you add money to your capital. You add money. So when you add money to your capital, your capital is what is getting your money. G gets. So that's that one. But let's solve question. Oh, thank you. So let's go to questions. Mm,
Hello,
yes, sir.
good evening.
Good evening, sir.
Yes, I wanted asking question then concerning, uh, but I will not take us back. But let me just
You can
put
just ask.
in increase in capital. When you were
Oh,
talking about increase in new capital, like you set an instance that if our dad dash us money and we now added the money into our capital, that means we have been able to increase our capital. And in another way around, what of in a situation whereby the profits are supposed to be declared to the stakeholder or to the shareholder when is not being declared to them and it is being increased, is being added to the capital. Is that one also an increase in capital or it is a liability?
Mr. John, please can you recap? Like, I'm so sorry. Like, I don't really get it. So sorry. Can you
Like
make
you
it
said,
loud?
can you hear me now?
Yes, I can hear you, sir.
I was saying that, like you said, an instance that when our dad now dash us money, we added the money in our business money.
Mm,
When such money is being added to the initial amount of money we have as a capital, that means
mm,
there is an increase in capital, right?
yes. Mm,
Mhm. And I'm also asking that what of a situation whereby the the profits that were being made from the business
yes.
and initially supposed to be declared to the shareholders in the business or
Mm.
in the company is not being declared, but rather it is being added up to the capital. Is it an increase in capital or it is being treated as a liability again?
Okay, thank you. So it is not a liability. I love that question. Kudos to you, sir. So in accounting, when we retain, it is called retain earning, right? So
Yes.
when we make a profit, and instead of we distributing it to our shareholder, when we distribute that amount to shareholder, it is called dividend to our shareholders. But if we
Yes.
do not distribute it to them, we call it what? Retain earnings. So that means we retain that amount and we use it for other what other business for business purposes, and that amount that we retain is what is a capital item, so it is part of the capital. It is called equity component.
All right.
Yeah, yes, sir. So let's solve
Thank
this
you.
question. Yeah, welcome, sir. So this example now, a purchase invoice is received from electricity charges for 2 3. Now this is what an invoice, and it is just what. So one thing in financial accounting is that if they do not tell you that they pay cash, you pay something, so it is payable. You're anticipating. See, one thing is, and it's very common. When I was doing my in my work of place where I worked, then it used to cause a lot of confusion because you will have thought treasury guys must have paid this money. And when you now trace the account, when you reconcile the account, you just get to know that they've not actually paid. And they'll just carry that amount and they put it in what is it called? I've forgotten the name of the account. So once they didn't tell you that they pay cash, please don't record it in your cash account. Just take it to payables. You are anticipating to pay it. Maybe you have received the invoice or you have issued the invoice, right? So you have not paid cash. So it is payable. You are anticipating to pay it. So for this example that they gave us now, it is an invoice. A purchase invoice is received for electricity charges for what? 2,300. This what is included in this one? It is a purchases of what? It's a purchase invoice is received for electricity charges. It is just grammar. This purchases now, it's not that you purchase. Electricity is everything that we know. Okay, this is electricity. Okay, I want to go and pay for electricity, right? What is going out? If you pay for electricity, everybody, you can answer. If you want to recharge your electricity, or how do we used to put it? Your electricity subscription, what account is involved? You can tell me the account that is involved. Okay, I don't know. I'll show you. Without, okay, you are seeing payable here, but can you just tell me, like, what is happening when you recharge for electricity bill? What is involved? The two accounts. Okay,
Expenses.
It's an expense.
yes, expenses and what? Expenses account. This remain another account. And what?
Expenses account either if the electricity
Um,
cash or
Electricity
pay
account
through cash
and
Payable
or cash
account.
account.
payable account.
No, yes, I know. Before payable, no, I want us to just, as a normal, let's say layman knowledge. Okay, you went to NEPA office. You want to pay for electricity. What is happening? What are you doing there? What are you giving out?
You're giving out cash or
Thank
a check
you.
as a payment.
Yes, thank you. Yes. So now it is expense, electricity and cash. And we know that electricity now is what is an expenses, right? But now in this place, they didn't tell us that they paid cash. So that is what I want us to say. Electricity and cash. But because they didn't tell us that they paid cash, and I've told you that if they didn't tell you that cash is involved, don't take it to cash account. Just take it to payable, meaning that you're going to pay later, you are holding that amount, right? So now for
Okay.
this one now, they said a purchase invoice is received for electricity charges for 2,300. So what is the double entry now? So it is what electricity and what's payable. Who is receiving the money now? So from this transaction, who is receiving the money? Who is taking money?
Electricity.
Thank you.
Electricity.
Electricity account is receiving.
Thank you. Yeah, that's correct. Thank you. So electricity is taking our money. That is why you see that we debit our electricity account. If you see this account now, so you said what? Debit electricity charges, and you what? Credit or total payable because we have not paid. Assuming cash is involved, now we'll have credit our what? Cash account. So, and I said that we are going to be using, this is John Ledger. I said we are going to be using what? Oh my God. Hold on, please. And I said that C format, this is what ledger account. So you have your left side, I said is what represents your debits, and your credit side, your right hand, it is what credits. So from this place now, you see electricity expenses. Then you've seen the how they draw the T format. So the debit side now. So this is electricity expenses, and we said that we are going to what debit what electricity expenses. You have debit. This is the debit side, your left side. What are you going to put if you debit it? This is T format now. So you put 2,300. What this trade payable means? What particular? This I don't know. Maybe you can draft it out in your notes, do T format. Then where they put this trade payable means this thing is what particular, what is the details. This 2,300 that you put in this electricity account. We said we want to debit electricity account, right? Yes, we have debited it with what 2,300. So this 2,300, what is it for? That is the details. So these trade payables that they put in this our debit side, I said left side is for debits. I will say we are debiting electricity accounts. So in this debit side, they now put trade payables 2,300. So these trade payables that they put is trying to tell us that this amount to in our electricity account, this is the details of what happened, not the full details, but the summarized details is trade payable. We want to pay for this thing. We have used electricity or we have purchased electricity. So it is trade payable and we have not paid for it. So it is the details. This side is for what? Details. And sometimes they will give you date, maybe January 1. So before trade payable, you write January 1. I'll send it to the group, the normal format if they want to give you the total breakdown. So it will be dates, details or particular, then the amount, that naira sign. So let's say January 1 now. Let's say this transaction is January 1st now. So you write January 1st in the debit side. So what details? What is the details? What particular? What happened? Trade payable, because what we purchased electricity. Electricity is taking our money, but we have not paid, and we have taken it to what payables account. What is the amount? 2,300. That's all. Then we go to what expenses was expenses payable. This
Paid.
expenses payables means what? So it's not trade. The reason why they put expenses payable is because it is not a full question. There's difference between trade payable and expenses payable. Trade payable means that if we are dealing with let's say cement now, if Dangote purchase instruments to make cement, that is what from a supplier, and he has not paid, that is what trade payable, because it relates to his line of business, what is actually producing. Did you get now? But for expense payable means that okay, oh, I just want to my employees, they are going out, they bought biscuits. It's not really related to what their trading activities. The expenses is not related to it. So it is what expenses payable. You get like discount allowed, salaries, is not really trade. So this trade payable means that the equipment we are using, their rate we are using for this cement, let's say conker or all this lime or stone they used to use. So it is trade payables, right? So that's just that one, and I've explained the. Can we say trade payable is a long term? It's not long term. I've mentioned it. It's a current term liability. Expenses payable no, is different. It's different. This is trade payable. That's what I'm trying to explain. Okay. So let me try and explain it again, Mr. I can't really pronounce Akpan. Yes, I guess it's Akpan. So, Mr. Akpan, for trade payable, let's say that you are producing cake. Yes, that one is better. For cake now, what are the instruments that we need to make cake? We need flour, we need sugar, we need margarine and all those things. So now, yes, thank you. So if you purchase all those things from your supplier and you did not pay, you are owing that person, right? So it is trade payable. Did you get it now? Because it relates to flour that you are producing. But now let's say that you now take a transport, you want to go and deliver the cake, right? So the transport expense now, so we can say that okay, you order a ride and you did not pay the rider. So it is what expenses payable. It is not trade because it's not part of the what cake. This thing is not part of the instrument. It is just expenses in line to make that cake possible, the delivery and the like. So we call it expenses payable. Is it clear? So payable, either expenses payable, trade payable, all of them, they are current liability. So this long term that you mentioned, that can we call trade payable long term? Yeah, thank you. So the payable can be long term. Don't let me explain that now. When we get to financial statement, we'll explain it. So let's go to the real question for today. It might take a long time.
I have a question.
Okay, you can ask.
All right. For the thing you explained last, if you mistakenly, as in change a trade payables to that electricity expense, are you wrong by the name? But the figures are correct. In the exam, are you wrong? The name
Okay,
of
you are
that
saying that okay, this electricity pay expenses now.
and trade payables. If you mistakenly debit the electricity expense and credit the trade payables, are you wrong? But the figures are correct.
Yeah, see, okay, yeah. See, we are still going to do all these things. I love accounting so much. It's logical. And this question you asked now, we are still going to do it. It's called errors in accounting. It's either error of commission, we have error of commission, error of omission, and the likes like that. Now, let's say instead of you putting this is electricity expenses. So instead of you putting electricity expenses in this place, I now put trade expenses. Is error of commission or is it principal error of principal or something? It's called one error in accounting. It's an error. Though your posting is correct, but it is what? It is wrong. The name of the person is wrong. Though your accounts will be balanced, but the posting is what? The name you put is wrong. It does not affect your account. In accounting, we call it error that does not affect your account, because at the long run, your account will be balanced, but the name you put is wrong. Is it clear now?
Clear, but is there a mark on it, or you're just totally wrong?
Now, if it is not, let me say, I don't know, but if it is not a question on correction of errors, because there is a chapter in FE that has to do with correction of errors. Yes, wrong classification. Thank you. So now it depends on the discretion of the marker, the person marking your script. I'm not marking ICANN script. So that is why when when we are writing ICANN, we used to say something, you read, you put in your efforts. This thing that we are doing now, we are teaching you is like, let me say 20%. You have to put in your words, your 70%, make it 90%. Then you see prayer service 100%. You have to pray. It has to do with the person that wants to mark. The person know that okay, maybe because of exam tension, then you forgot to classify it. Then though your posting is correct, then the classification is wrong. The person might give you, but it is wrong in accounting, but does not affect your accounts. So it depends on the person that wants to mark your account, your scripts. So you have to be praying for that. God have mercy on me. Do you get that?
It's okay. It's okay. Thank you.
Yeah. Welcome. So let's just go to question. All these things we have explained. So I would like us to just go through it when you get to like after the class, and anything you don't understand, you are free to enter my DM any day, any day. So let's do this example. Adeyemi, I guess you must have done it before. I don't know. So this Adeyemi, now this is the question you are going to be doing. You can screenshot it because I would like to change it to.
Can you see your money yesterday? Can you see
Hold
your
on.
money yesterday?
I can't hear you. Are you talking to me, sir? Hold on, please. So we'll be so sorry for that break. So this illustration with all our explanation, then I would like you to take your notes and be doing the TIFF format as we are doing it. Though I will send the material to the solution to the class group after the class. So let's just take Adeyemi. So now this illustration has to do with what? Let's say Adeyemi, a business owner. So the first one is, so we have 10 transactions. So prepare journal for the above transaction. This is, so before journal, let's just do the, okay, yeah, I know that this is not true now. This first one, the ledgers, let's do the ledgers. Okay. So Adeyemi. So prepare, post all transactions to what? To ledger account. So now we'll start posting these things and coming. Okay, thank you. So this is Adeyemi, right? Oh God, this is wrong. Tell me I'm having issues. So the first transaction they gave us is Adeyemi. Sorry, I guess I don't need to just wait. Can we see this thing? Can we see it now? Can we see this transaction?
Yes, please, yes.
Okay. So the first one is, oh God, please have mercy. Should have. What's, sorry, please. So this is the question. So Adeyemi introduced 30,000 cash as capital, right? So Adeyemi introduced 30,000 naira as capital. So who can tell me, based on all the explanation we have been given since, now say Adeyemi introduced 30,000 cash as capital. So what is the two transaction, the two accounts that is involved? So we just know it. Please, you can just can I call anybody or Mr. John? Yes, Mr. John, please, what is the, okay, thank you. Okay, I love that. Cash and bank. Okay. Someone is laughing. I
Cash
don't
and
know.
capital. Yes, I can hear you.
I
Cash
can
and
hear.
capital.
Thank you.
Debit capital.
So someone said credit capital account. Someone said cash and capital. Thank you. Excellent. Cash and bank. So I don't, okay, Jonah. So Mr. Shion. So can you please unmute your mic? Why did you say cash and bank? Like, why? Just you can defend it, you know. Mr. Shion, are you there? How do I split? Mr. Shion, should I just continue and not call you? I can do that, it's fine. Come in first. Side by side. No. Okay. Mr. Sheon, are you there? Okay, let's just continue. So the two accounts that is involved, someone already said would debit was. Please write it down. You debit your capital, your cash account, you credit your capital. So who can defend that? Can you defend it? Don't know why my screen is about the one that is misbehaving. I don't know. Who can explain why are we debiting it? Because this thing now, all of you said okay. Eniola, do you want to explain that?
Yes, I can try.
Okay, please explain.
Okay, so first of all, the capital.
Yes.
The cash, I mean, because we debit first before we credit. I don't know if I'm right.
I don't get that.
I said
Can you
we
speak
debit.
up?
Can you hear me?
Yes, I can hear you.
Yeah, I said we debit first before we credit.
Why are we debiting first? Why are we crediting first?
We are debiting cash.
Why? That's what I want to know. Why are we debiting cash?
Yes, this is because the owner of the business has the assets. He brought the asset present in hand.
Good
Okay.
evening, please. Can I speak?
Yeah, you sure you can?
Okay, so the
Wow.
correct thing will be that we are crediting cash and we are debiting capital because the capital was actually like being introduced in from cash. So cash is the one giving out the money and capital is the one receiving it. So that's why we are
Yes.
crediting cash and debiting capital.
Okay. Is someone okay?
Okay,
Mr. Bly, do you want to
Mr.
say
Bly, do you
something?
want to say something?
I don't know why my first is
I don't know why
open.
my first is open. Yes, yes. Can I speak? Can I speak? Hello, can you hear me?
I can hear you. I can hear you.
Okay, we are debiting cash because cash is an asset. And when
Okay.
asset is increasing, you debit it.
Yes.
And
Thank you.
we are creating capital. And when capital is increasing, you credit it. That is the reason.
Thank you. So based on what I explained the other time, let me just thank you everybody. Thank you. I love our contribution. Please hold on. Okay. Mr. Tutor, are you trying to say something? Thank you everybody. I actually love our contribution and it makes sense. Mr. John, please, I'm coming. So I would like to take us back to where we are coming from. And this thing that I was trying to explain the other time. So they said now that Mr. Adeyemi, now where's our question? Mr. Adeyemi introduced cash as what capital. So that means that what it takes like 30,000 naira from his personal account and he puts it into his business as what cash, right? Okay, he introduced cash. That's how they can put it. He introduced cash of what 30,000 naira as capital. He put another money. He added money to his business, right? I mean, meaning that what is happening? Capital is what? Capital is increasing, right? And what happens to our assets, our cash?
Our cash will be reduced.
So no, okay, yeah. So now,
No. Can I say something?
Sure, you can.
I think when we look at this from the angle of when cash is increasing, we deduct. When cash is reducing, we credit. I think we can understand it more better from that angle. In this case, cash is increasing. That is why we are debiting. And capital is decreasing. That is why we are crediting.
No,
Thank
capital
you.
is thank you, sir.
It's
Thank you,
actually the
sir.
other way around.
Yeah, thank you. Thank you, everyone. So now they said where is this thing? So Mr. Adeyemi introduced 30,000 naira what cash as what as capital, right? So capital is what is receiving. And if you notice, the first thing I said when we started this class is what you debit the receiver and credit the what the giver, right?
Yes.
Right?
Yes.
So now Mr. Adeyemi introduced cash as what? As capital. Capital now is what? What happened to capital? Capital is increasing, right?
Yes.
You credit your capital and you debit your what? Your assets. You debit cash and credit capital. Is it clear?
No, Mike, it's
Yes.
not clear.
It's not clear, man.
So
It's not clear.
Okay, so let me look for other ways to put this. So I said that for every debit entry, there must be a credit entry. That one is clear. And what is going out? What is going out? You do what? What did I say to what is going out?
It's credit.
So I said debit what comes in and credit what goes out, right? So now what comes in now is what?
Debited.
You said?
It's
Capital.
debited.
Capital.
Capital.
It's not
So
clear now.
introduce cash. Mr. John, why
It's
did
not.
you
Can
raise
you
your
please
hand?
recap from the debit side?
Hello.
I know where we are getting the confusion from, but then it's fine. So for the cash, right? So cash increase in what? In cash of the capital. See this majorly for cash, and when they introduce cash and capital. So this thing now is like he introduced cash as capital. You see that is just something that is happening to the what? To the business. Now you are taking money to your business. So you have cash and you have what? You have capital. Did you get? It's just like I know that okay, I put cash in my business. Who is the owner of the cash? Me. Who is the owner of the capital? Me. Capital is what? So when a question states that introduce, firstly when a business owner introduce capital to the business, something is happening to that account. It is a fresh this thing. Then let's call it fresh. You are introducing both the cash. So and I said that cash has a debit balance, right?
Yes.
Now we are not preparing Mr. Adeyemi's account. We are preparing the business account. Money is coming into the business. Did you get?
Yes.
Both cash and capital is what they are receiving money because Mr. Adeyemi, like let's say please you can mute your mic, so when I'm done if you have questions so you can just ask so that for better understanding for everyone. So like let's say Mr. John, now you have another business aside from your salary earning this thing. So let's say you now introduce said okay, let me add 30K to my business, and believe me, we are not preparing your account. See, there's this thing when you are doing accounting in a firm, right? Accounting is very broad that it used to cause arguments, and you have to know. That is why I said that double entry is very important, because you have to argue on it every day with your colleagues. You have to argue on it every day. So now we are not preparing Mr. Adeyemi's account. We are preparing his business account. Do you get now? So Mr. Adeyemi introduced what cash as capital. So something is coming into the two. Capital is receiving the money as far as what with a cash too. So he introduced cash. So that means the cash of the business is increasing, and capital also is what is increasing. So, and I said that the increase in capital is what you credit it, and increase in your assets. If you check your this thing, check your notes. You can check your notes and see what we said. An increase in assets, you debit it. An increase in what in capital, you credit it. I don't know, maybe this thing is clear. He introduced money into his business. Assuming we are preparing Mr. Adeyemi's account now, that is different. Do we all get this thing? But now we are preparing his business account. It take money, like it's both sides. It's affecting both sides. It's just plus plus. Our asset is increasing. Our capital is also increasing. Do you get? So you debit your asset that is increasing and your capital that is increasing. So you credit it. Is it clear? Yo, thank you, Miracle. Is everyone clear? If you are not clear, you can just raise your hand so I will know that you are not clear. Yeah, thank you, everyone. So once you see that they introduce capital, okay, Miss, is it Miss? Okay, what are you not clear with so that I can explain? Hello, you say you're not clear. Can you unmute your mic?
Yes. Hello.
Yeah, I can hear you.
Maybe you'd help me recap. It's just very confusing. And maybe when you repeat again, I'm sorry to take the class back. I'll be able to understand.
Okay, now.
It's
So
very
let's say
confusing.
Adeyemi now, Mr. Adeyemi now. Like you are the Mr. Adeyemi that we are talking about now. You can unmute your mic so that it will flow. Do you get? Yeah. So the Mr. Adeyemi now that we're talking about, let's assume you are the Mr. Adeyemi. So now you own a bakery and you want to expand your business. Can you please, Mr. Gbenga, please mute your mic, please. So the person I'm talking to, I don't really know your name. I don't know how to pronounce it. So, like, let's say that you own a bakery and you want to expand your business. Then from your personal account now, you now take 30K, right? You take 30K into your business account. Now, let me introduce this thing. Let me add so that my business will expand. So that 30K now, you take it to your business. See now, this account, I said that we are not preparing personal account. We are preparing it for a business.
Yes.
Adeyemi business. So now, when he introduced this money into his business, what happened? The cash increased, right?
Yes.
What happened to capital?
It increases.
So, yeah. So when capital increase is what we do we do to capital when it's increasing?
I don't know.
Are you just joining?
Yes. That's my first
Okay.
class.
No. You joined from the beginning of this class.
Please come again.
From the beginning of this class, I said that Mr. John, please. So let me just take you. Please, are you with me, please? So that I don't think we can end this class better.
Yes, I'm with you.
I'm with you.
All right, thank you.
Yes,
So I said that, see, this account now, increase in expenses, increase in assets, you debit it. increase in liability, increase in capital, you do what? You credit it. So that's what I'm trying to explain now. So in this account, the first transaction they gave us now, what happened? Our cash is what is increasing and our capital is what increasing. So increase in assets, cash is an asset. I've mentioned that cash is an asset, so it is increasing. Then what to debit it? Yes, I said debit as a cash account.
Okay, understand now.
Sorry.
Thank you.
Do you get it now?
Yes,
So
thank you very much.
everybody should jot that in their notebook. Debit your assets, that is cash accounts, and credit capital accounts.
Can I ask a question, please?
Yes, you can.
Okay, good evening.
Good evening.
I know normally when an account is receiving, we debit. When we are giving out, we credit. Why are these ones different? Why are we crediting capital when it's increasing?
Okay.
Or it's just a normal rule that we should know?
Not
There is no
a
reason for that.
Okay, I said this is it. This is different from. Okay, you understand that?
Yes, I know that when asset is increasing, we debit. When
You know
capital,
that, right?
income, liability is increasing, we credit. I'm asking, is it like normal? Maybe that's the rule, or is there a reason behind that? Because the normal general rule we know is that an account that is receiving should be debited.
Mr. Agba, let him mute the mic, please, so that we can hear what you're saying.
Can I continue?
Yeah, you can. Thank you.
Okay, I said I know the rule, like asset when it's increasing with debit, liability, income, capital with credit.
Yeah.
But like the normal rule I know is that when an account is increasing, like is receiving with debit. So why are these ones different?
Okay. So the first one is not different. And I already said it that it's just that this introduction of capital into the account now, it seems like a bit confusing and a bit different, but it is not different. Now that's what I'm trying to explain, that you introduce something. Let's say this is a new business, you just introduce it, so you have the cash, you have the capital, nothing is happening to the two. Did you get?
Yes.
Yeah, nothing is happening to the two. So both cash and both capital is available. We have not used it. We have not touched it. You just introduce it. So it's in the account. We have it in our account. Did you get?
Yes.
It's like you open a shop. You have all your what you want to sell, all the provision you want to sell. Then it's there. You just like, no, you've not bought the provision. You want to, like, you have sketched out your business proposal, you have your capital, that is the cash you introduce. So in accounting, this is my capital now. I want to start a business. This is my capital that I introduced, 30K. Then it is called what? Cash. The other leg is what? Cash. So in accounting, we will not record only capital, but we'll record the second leg. What is the second leg? We have cash. Did you get? So that's why the cash that we have now, it is what? It is the debit balance because we have it. Then the capital that we have now, it is what? It's a credit balance because we have it. If we don't have capital, it is what? It's a debit balance. If we don't have your cash, it is a credit balance. Is it clear?
Yes.
Yeah, thank you.
Thank you.
Can we continue?
Yes, we can.
Yeah. Thank you, everyone. Mr. John, please, do you have question? No, I guess.
It's just that I wanted to.
Please mute your mic. You can type your question. Mr. Okay, thank you. So let's go to the second one. So Adeyemi borrows 40 million to purchase a van. Adeyemi borrows 40 million to purchase a van. Now, see, I have explained this thing why during the class, right? During the course of this class, I said that there will be a transaction that they will just put, like, it will include like terms accounts. You know that I said that in a transaction you must have what? Two leg, debit and credit. But in this one now, the first thing that happened is what? Adeyemi borrows. That is the first thing that happened. In the second transaction now, I'm trying to break second transaction down. Adeyemi borrows. Then the second one is what? He now purchased a van. Right? So you have to break it down. That's one thing in accounting. So that is one thing in what? In accounting. You have to what? You have to break it down. Adeyemi borrows. So Adeyemi borrows now is what? It's called what? A loan. Right? So what are we going to do to that? Adeyemi borrows. Before we go to the purchase, Adeyemi first what? The first thing that happened is what? He borrow. So what is the accounting involved? You can type it if you know what is the accounting, the double entries that is involved in that. You can just type it, please. Okay, thank you. Before motor van, loan and cash. That is what is involved. We borrow what? We borrow loan. You also, yes, loan. Before even knowing what, okay, before even know, are you to debit it? Are you to credit it? What are you going to do? Now, loan is what? You credit loan, right? And your what happens to your cash? You debit it, cash is coming in. Do you get loan accounts now? Loan and cash. So you write the entry like that. Adeyemi borrows. Yes, thank you. So you debit cash, you credit loan. That's the first thing. So the second one is purchase a van. So they purchase a van now. That is what? Purchases and what? Van. Sorry, purchase a van. That is what? Cash and what? And van. Yes, thank you. Cash and motor van. Thank you, Mr. Badmos. Thank you. Makes sense. Thank you, everyone. So that is what the first one for that second transaction. Adeyemi borrows loan. So loan and cash, you debit cash and you credit loan. Then for the second one, purchase a van, because van now, the reason why, you know that as long as it's an expenses that is not just normal expense, it would have what? Debit the purchases instead of van. But van is what? Motor van is an asset. It's a tangible asset. That is motor vehicle. It's a tangible asset. So we debit it and we credit cash that is going out. You debit what is coming in and debit what is going out. Is it clear? If it's not clear, please talk now before we proceed.
It is not clear.
Okay, me says Olamide. Did you get the part of loan? Is that loan aspect clear?
I got the part of loan.
Yes, you have loan, you have cash, you borrow loan. Loan now is a payable, is a liability to you. So your liability is increasing, you credit it. Assets now is cash, you have assets. So you debit that one. That one is clear. So now you have borrowed. What did you use the money? The money you borrowed, they say you borrowed. Instead of me borrow, what did you use the money to do? To do what? Buy motor van. So van. So the van that he bought now, who is taking the money? Van, right?
Yes.
Then he's giving what out to buy van?
Cash.
Yes. So we debit the what? Debit the receiver, credit the giver. Who is the receiver? Van. Who is the giver? So the giver is what? Cash.
Cash.
Clear.
Are we now doing two double entry for that?
Yes. But if you look at it, write it out in your notes, and you will see that in your cash now, something is canceling out each other. Check your cash account. Write it out. So now you have like this is it. The first one is you debit what? You say you debit your what? Your cash, right? Debit cash, credit what? Let me write it together. You debit cash, right? That is it. Debit cash, then comma, credit what? You credit your loan, right? Then another one is that you now use the loan that you collected. You use it to do what? So buy a motor van. And we said that motor van is taking our money. So the motor van, I will say you debit what? Debit motor van. Debit van, right? And credit what? Cash is going out. Abi, did you agree? Is it Mrs. Tope or
Yeah.
Oluwa? Yes. So you credit cash that is going out, right? Because you purchased a what? A van. Now, if you open this, you know that we have received this loan now, we receive cash of how much? 40K as a loan. Somebody loan us. If I loaned you 40K now, you collected it as a cash. You debit your cash account that okay, you receive something from someone as a cash. Then the money you receive, you now give it out again. So buy what? A motor van. That means that it has cancelled out each other. But in accounting, you must write it out. But I'll send it to the class group. I will send the solution to the class group, right? Just follow it calmly. Yes, thank you. Thank you. Is it clear now? I don't know if it's clear.
Yes, it's good.
Don't worry. When I send out the solution to the group,
Clear.
it is clear. Thank you so much. I'll send the solution and you will love it. I don't know how to double share this thing, but then I'll send the solution. Keep trying, don't worry, you get it. It's just that you borrow something, then you use the money you borrow, use it to buy something. So what comes in, it goes out. So we are left with the loan account that we have not paid and the motor van that we have. If you look at it, when we borrow loan, how many entries are we? So this question too now, the first thing that you are going to prepare is your loan and your cash account. You receive loan, you debit your cash, then your loan is what you the loan you have, because the liability you credit it 30K. So do your T formats like that. So I'm going to send the solution. Yes, thank you. 4 entries. So after that one now, they now told us that that amount it is used for what? To purchase a van. So for your van now, what are you going to use the van? So the van that you bought now, that means the cash now, that loan you receive as cash, you are taking is going out again for the purchase of a van. So you debit van account and you credit your what? Your cash. That means your cash, there's nothing in your cash account again. Debit. So this is one thing in account. When your debit and your credit is equal to each other, that means they cancel each other out. That's been cancelled. So we are going to explain that. I don't even code. I guess I need to split my screen. Call me. Present something else. Okay, me. Entire screen. Okay. Sure. Can we all see this? Okay, thank But let's just continue. You can't see it. I don't know why my okay. So Can we see this?
Okay.
Yes.
Hmm. So thank you. This is what I'm trying to explain. Mrs. Basirat, please mute your
Basirat
mic.
now.
So thank you. So this is what I'm trying to explain now. So this is the loan. This is the cash. We receive a loan, right? This is it here. This is it, loan. So you debit your cash. And I've already told us that this is the what? This is the amount. This is the particular, the details, loan that we receive. So we have debit our cash account. So this is it here. Then where's our loan? The loan, this thing, the loan account. Where is my loan account? Prepared somewhere. So this is loan account now. See loan account, cash. We said that we should credit our loan account at this. It's because I have finished, I have posted something else. So this is it. This is the cash. You credit your loan account, right? So that is that. Then for the van that we they use the money to buy. So see the bank account, the cash account. It is cash. So this is cash, 40K, right? So we debit our van account, then you credit your what? You credit your cash. Where's the cash? I'm still going to send this CD. So this is the 40K for what? For the van that we purchase, right? I want to style it. Oh, I don't know. So this is the highlighted this thing. This is the van that we purchased. Let me highlight it. This is the 40K here. This is the debit here, the loan that we receive. See the two. I don't know, maybe I'm making sense. So we receive a loan. We said that when we receive the loan, we debit our cash account. So this is it say. Then when we bought a van, we credit it. This is it say. So this minus this 40K minus this one is giving 0. That means we don't have anything in our cash account again. We receive a loan of 40K and we use the loan to buy a van of 40K. I hope that is clear. Yes, it is. So let's go to the second one. Yeah, okay. So the third transaction now, hope you can see it. So the third transaction is Adeyemi buys a market store for 5,000. Please just tell me this accounting entry, the double entry that is involved, debit and this thing, and anything, market store. And, okay. I'm still waiting for all that. So it's only 2 people that responded to this. So buys a market store. Thank you. Cash and market store. I love that. Not sales. We didn't sell anything. Buy, not sell. Buys a market store for 5,000. Like a market store is like, I don't know, store like you bought. Don't look at the amount that they put. Like you bought a shop, like a store. So a store is an what? Is an asset. Is an asset, right? So that is why you have to be an asset. Yes, thank you. So assuming it's an expense, you should some of you put purchases, right? So you debit what store and you credit cash. That's just it. So here now, where's my sim? I credit what? I credit my cash and debit store. So this is this market store 5K. This is it here. Then you go to open your market store account, credit and debit, then put your Naira sign, then you put your cash here, then You put your 5,000 naira there, write it out in your book. See, one thing, assuming this thing is physical, like it will have been easy for you because you'll be entering it together on a board and it should have make sense. Do you get? But now I'm trying to show you that okay, this is cash now. This is your market store account because I've done this thing. And if I say I should be entering it one after the other, it will be slow. So what are you going to do is that what you debit you debit market store, you debit store and credit and credit cash because we are giving out cash. So this is our market store account. Then you say you debit market store. This is it. So and I said the details, the order it to be the what you use that things to do. So this market store now is cash account. You're going to put cash 5,000. Then you go to cash account. Where is our cash account? So this is our cash account. See the store here, market store 5,000. Is it clear?
Yes.
Thank you. Thank you. So let's go to the fourth one. Adeyemi buys inventory for 18,000 on credit. Please just impute it like that. Tell me the transaction without wasting time. Adeyemi buys inventory. And if you don't understand, so this is not a physical class that you'll be shy. Just talk or just send a message that I don't understand. I will wait and explain for you. And even though after this class, if you don't still understand, my DM is open. Thank you. So for the fourth transaction, Adeyemi buys inventory for 18,000 on credit. So this in a cash is not involved. I'm not seeing people. I'm not seeing your response. So tell me the double entry, please.
Trade payable.
Yeah, trade payables and what? Inventory and payables. Thank you. Payables.
Inventory.
Yeah,
These are
yeah.
payables.
Debit.
Or purchase.
Inventory care. Yeah, purchases are payable. Yes, Badmus. Thank you. So people that said inventory and payable, yes. But then I said that this inventory now, it is not, we are seeing the basic. So let's just say, okay, inventory. Inventory in accounting is an asset. If it is closing inventory, don't let us go to that side. So closing inventory, let me just explain. Closing inventory in accounting is a current asset. Why opening inventory? The difference between opening and closing inventory is that at the beginning of the year, opening inventory is that okay, this is the store, the amount of item I have in my store. That is your opening inventory. Then during the year, you begin to sell it, right? One after the other. You are making a sales, okay, you are selling, the customer are coming in. So at the end of the year, when you now do your store counts, anything that is remaining, it is called closing inventory. So that your closing inventory now is an asset in accounting. So it is what? So that is why we categorize closing inventory as what? As a current asset. So always remember this now. So because that when we now get to our financial profit or loss, your profit or loss, you will now remember that okay, my closing inventory, I have to take it to my balance sheet to is a current asset. So you will not forget that. Okay, don't forget that your closing inventory is what is an asset. That's what I'm trying to say. So now, but this is just basic. It's either you use purchases. So the ICANN study pack, they use purchases. They said that we should just ignore inventory for now. We should just put it as an expenses. So they use purchases and what and payables. So you debit your purchases and credit payable. Is it clear? Thank you. Yes. Thank you, Adironke. Yeah, so let's go to the fifth one. Time is not on our side. So Adeyemi pays his supplier 10K. Eniola, are you still on the call? I would like you to answer this. I explained this the other time. Eniola, are you on the call? I guess not. So anyone that I understand, they can just. I have explained this thing, but she was the one that asked this question. That is why I called her. So Adeyemi pays his supplier 10,000. So what is the transaction? What is the double entry? I've explained this thing the other time. So before Adeyemi could pay his supplier, that means Adeyemi has bought something, not loan, no. That means I was explaining that you bought something. Yeah, thank you. You can say it, yeah. Cash and what?
Trade receivable.
Is it receivable? Think about it.
Pay supplier.
Thank you, Funke. Yes, it is cash and payable.
Cash
And
and payable.
yeah, that is why I called Eniola. Is it Eniola? I don't even I can't remember her name. The lady asked the other time, and I was explaining that your supplier, if you bought something on credit from your supplier and you have not paid, that is payable. Later when you pay, it's not cash. Now your supplier, now we have bought something on credit from our supplier before, all right? We didn't pay. That is why they say you see what is trying is this transaction 5 is still signal to transaction 4 if you check it, because transaction 4 we bought inventory on credit, we didn't pay 18,000 naira, we bought it on credit. Now when we now go to the 5th transaction, and I'm telling us that Adeyemi pay his supplier 10K. So before you can pay your supplier, that means you have bought something on credit. Did you guess now? So now the first transaction, we say you debit your what? Your purchases and credits payable. Now when we now go to the 5th one, they say Adeyemi pays 10,000. So out of the 18,000 that Adeyemi is owing, he pays 10,000. So what are we now going to do to that? You debit your payable account because your payable is reducing. This thing is still going back to what we explained earlier. Your liability is reducing. So you debit payable 10,000 and what? Your credit, your what? You credit what?
Cash.
Thank you.
Credit cash.
Thank you. So thank you. Let's go to the 61. Adeyemi sells inventory for 12,000 cash. This one is straightforward. So everybody should answer. What is the double entry? Sales and yes.
Sales and
Sharp.
cash.
Yes.
Sales and
Sharp.
cash.
So what are we debiting? What are we crediting?
Debit purchase and credit cash.
Why purchase? We've already agreed that it's cash and sales. Purchase. We've
You're
already
crediting.
agreed that it's cash and sales. Yes, because both, see, one thing about capital and sales is that you sell. Sales is like you sell something, and the sales is like, okay, I've sold something. Oh, people come and hear, oh, I don't sell today. Oh, okay, what did you sell? I sold an item for 5,000. Is it 12,000? Right? What did you receive? Cash. It's still win-win, right? So that is an income. So you debit your cash that is coming in. Your cash is increasing. Your sales, so you make sales is increasing. So sales is like income. So you credit it is increasing. Your debit, your asset that is increasing to your cash. Somebody is raising hand, Abi. Is he still raising his hand? Are we clear?
Yes.
Yes.
Okay, so Mr. Oluwasegun, you can mute your mic. Then let's go to the 7th transaction. Adeyemi sells inventory for 9,000 on credit. Yeah, I love this one. I love this one. So who can try? If you can just type it. Thank
Cash
you.
and
Shield, thank you so much. Yes. Sales and
Payables.
receivables. It's not payables. So see, I've already explained the difference between payables. I said if you are paying your, you can miss your mic. If you are paying your supplier, like you are owing your supplier, the people that are supplying the raw materials to you is payable. But when your customer now, people buying from you, when they are owing you, they are expecting to receive from them. That is receivable. So in this sense now, Adeyemi sells inventory. They are the one that sold. People are owing you, not that you are owing people. People are owing you. So you are the one expecting to what? To receive. Is it clear? Yeah, so it is receivable. So it is what? It is cash and receivable.
Receivable.
Is it sorry, sales and receivable. Thank you. So what are you going to do? What are the is it what are we debiting? What are we crediting? 7 yes. Yeah, thank you so much. You debit receivables and credit your sales 9,000. Is it? Yes, that's that. If you don't understand, please let me know. Then the 9, is it the 8th? Yeah, the 8th transaction. Adeyemi repays 10,000 of the loan. You remember that at the beginning, is it? Yes, it was transaction 2 that he borrows how much? 40K. So now he now repay 40K now. He pays, his liability is reducing, Abby, right? And you remember that I said that if your liability is reducing, you debit it, right? So you are going to debit your loan account with how much? With 10,000 and credit what? Bank.
Cash.
Cash, thank you. Cash, it is not bank, is it cash? So let's just assume it is cash. Because they didn't say it. So this one now, you cannot say it's payable because you cannot be assuming you want to pay loan. When you pay loan, yes, credit, cash, and debit too. So that is that. Let's move forward. So the 9th one, Adeyemi pays his trade supplier 6,000. Yeah. Why? Mr. Aliyu, which one are you talking about? Miss Okay, you can okay, Chukwu something. Do you have questions? You raised your hand.
Cash and payable.
Which one are you answering for? Are you talking about the 8th transaction or the 9th transaction? We are doing the 8th transaction now. Deborah, are you talking about 8? We've done 8 and people are dragging me back to that 8. So sorry. So for the 8th transaction, Adeyemi repays 10,000 of loan. And I said our loan account is reducing. What you are owing is reducing. From 40K now, we pay 10K. So you debit your loan account 10K and you credit cash. That is that one, not payable. So let's move to the 9th transaction. For the 9th transaction, Adeyemi pays his what? Trade supplier. You remember that Adeyemi buys from the 4th transaction, he bought inventory of 18,000 on
So
credit.
that is cash and payable.
Yes, and now he has paid the 9th transaction that he said he pays, and he has already paid. So he paid 9,000 before. He paid 10,000 before. Yes, now he pays another 6,000. So this one that Adeyemi pays now, he pays 6,000. So what are we going to do? Cash is going out, right? You credit cash and you debit what? Payable. Thank you. Is it clear, please?
Yes, it's clear.
Thank you.
Yes, it's clear.
Thank you. So let's go to the 10th transaction. So Adeyemi received 8,000 of the money owed to him by the what? By the customer. So people that bought on credit, you know that they said that which transaction is that? Transaction 7. This transaction he sold on credit, right?
Sales
He
and
sold
receivable.
inventory, yes. So to his customer. Now then I said that Adeyemi received 8,000 of the money owed to him by the what? The customer. They even help
Cash
you
and
and
receivable.
yes, thank you. So you debit cash and credit receivable. The receivable is reducing, right? So that means that your asset is reducing. Thank you so much. I think that you are getting it so fast. Yeah, I love that. And so let's go to the 11th one. So Adeyemi purchases another 2.5 of what of shirts on credit. So what is that? Purchases and what? Payable.
Payable.
Yeah, so we are doing the 11th transaction now. Yes. So purchases and what? Payable. So you debit purchases and credit payable. Abi, it purchases what? Yes, thank you. Thank you. So the 12th transaction now, Adeyemi drew 4,000 cash out of the business and also took inventory. So I've explained this thing the other time that as a business owner, it is December. You want to do that December. Adeyemi wants to do that December now. So now he now do 4,000 naira from his business. Let me take care of myself. I've been doing a lot for this business since the beginning of the year. Let me just take something out and enjoy myself. So he drew 4,000 from his business account, right? So that drill now, I called it one name the other time. Who can remember? If you can remember. Drawing. You guys are too much. I love that. Yeah, thank you. So it's called drawing. So Adeyemi drew what? So that drawing, I said that our capital is what is reducing, right? And we're going to do what? We are going to debit it. We are going to debit drawing account, and you credit what? Cash. Because it's yes. So that's the first one. Yes. So the second one, Ali, Ali, you can mute your mic, please. Yeah, thank you. So Adeyemi now, both he withdrew cash and also took inventory. So the inventory is also drawing. So you debit in drawing of 4K and you credit cash 4K. So the second transaction is that also he took inventory of 2,500 for his own use. So what are you going to do is that you debit drawings. How much?
2.5 and credit inventory.
Yes. 2.5. Thank you. So that is that. That is that about that. So that is that. So we need to, I don't know, should we continue? I would like us to balance our account and I'm trying to look for the drawing, what I put there. Purchases. That is what I want to get. This drawing. Okay, Ali, I'm coming. You know that this our inventory now. What did we do? He said that I can, if it is me, I will have done drawing and inventory. But I can, based on this, when they were trying to explain, I checked because the first time I stopped it, I used inventory and drawing. And I said that's based on, because it is basic questions, we should assume that there's no inventory account. It is not a trading thing, that they just use the inventory. So the inventory, they take it as what purchases because he has purchased inventory before, right? Now, when he now took 2.5 from the what? From the inventory that he owns, the inventory in the store, meaning that the what he has purchased before has reduced. So that's why they credit what purchases instead of what? Instead of inventory. So okay, Chuku Ogene, you have question? Sorry, I can't pronounce your name very well. You can ask your question.
Okay, good evening, everyone. Sorry, I have to take you back. There's this question, number 3.
Okay.
I saw someone typing a purchase, but he said that we should use the name that market store. So why are we using the market store? Is it because it's an asset?
Okay. Market, yes, an asset. Yes, a store, like it's a building. Building is an asset.
So what about rent, for instance? I've seen some account like rent account, and those are expense. So I don't know. the difference? So when are we going to open just what called that an access account that has a name, and then expense that has a name? I don't know how to put it, but there are some accounts like that you see, like rent account and all that.
Yeah. So now, if they like electricity now, if they said paid electricity, if they said Adeyemi paid electricity 5,000 naira cash, what are we going to do? We're going to debit electricity and credit cash, right? Like, are you with me? You can unmute your mic. Are you with me?
Yes, ma'am.
Because
Yes.
yes, that is an expenses, right? Mr. John, please mute your mic. So that's so that is, but for rent now, rent also is an expenses. But if they specify it, like this one, they say buy a market store, they didn't say rent. Then the rent in accounting, I guess maybe IAS 16, we are going to deal with that. Is are we going to capitalize? But then majorly rent and expenses, because it's not for a long time. Like, I don't know, it depends on duration. Like the rent, it's not like it's not even tangible. It's not tangible, so it's an expenses. I don't know, maybe I've answered your question. Have I answered your question? Yes, I guess. So should we just balance our accounts now? Mr. Aliyu, yes, you can ask your question. You can ask your question, no?
Hello, good evening.
Good evening.
Sorry, I want to ask a question about that last transaction, that number 12 transaction. I think my network says when you are explaining. I understand about the drawing account and cash account is going to affect the first part. But the second part, the inventory account and which other account will be affected? That's my question.
Except purchases.
Okay, for you. So expenses. Okay, thank you.
You're welcome. So now, like, I'm asking, because time is not really on our side, should we just balance our account? I don't know, is everybody writing the format in your this thing? Did you open it?
10,000 slash 2,000.
Yes. Should we continue? Then we just end it. I will just make one. I will cite an example. I will use like the first 2-3 transaction as an example. Then the assignments will be that you guys should complete it and send it to the group, or you send it to my DM before sales day. Is that okay by us? Should we continue? Yeah, thank you. So
Please,
now
for number 7.
the third one.
Number 7.
Adeyemi sells inventory for 9,000 on inventory. So what is
On
the account? What
credit.
is the number 7? Yes, that's number 7 now.
Yes.
Yeah. Aremu sells inventory for 9,000 on credit. So what is involved is that the inventory, they're just selling inventory. The inventory is that this person, this Adeyemi, is selling something, but they don't want to mention what it's selling. So that's why they're just using, he sells inventory, he buys inventory. They don't want to mention what this person is doing in particular. What is the thing the person is selling? They don't want to mention it in this question. So they now said that Adeyemi sells inventory for 9,000 on credit. So okay, I'm selling clothes. Let's say Adeyemi is selling clothes now. So Adeyemi sells clothes for 9,000 on credit. So what is the distance that is involved? It is sales. Anything that you are selling, if it is television you sell, it is sales. You won't put television. What did you say? What are we going to categorize? It is sales. Anything you say, it is sales. I sell this and it is sales. Sold Kenikon, it is sales. Do you get? So it is sales. So you do what? You credit your sales account, because sales is an income account and your income account is increasing. That is sales. So you what? You credit it. Right? And you do what? And you what? On credits, and you debit account receivable, because you are your customer has not paid. Is it clear now?
Yes, it's clear. It's clear. Thank you.
So let's go to, I said we want to balance our account now. So based on what we have entered now, so let me start from the beginning. So when we start, you said there's we debit our cash accounts, we credit, um we debit our cash account for the first capital that was introduced. This is the capital that was introduced, Abi, right? So this capital now, you debit it and you credit your capital account, you debit cash account. So this is our cash account. A lot of transaction has occurred and we have entered it. And I don't know, like if you don't understand, I'll try and do a video of me entering it one after the other and send it to the class group. If you don't understand, you can let me know on the class group on how to enter the transaction one after the other. Do you get? So what I did now is that a lot of cash this, cash that, motor vehicle cash, loan cash, payable cash. You will now open various cash accounts. It is just one cash account you are going to open. And then for the capital too, yes, I will. Thank you. So then for the capital account, it is just one capital account that we have. So the capital account now, you just do what? Just one capital. Now, this purchases now, you will remember that you mentioned a lot of purchase account. It's not that you are going to be opening a different purchases account. It is just one purchases account that you are going to do what? That you are going to open. So what I'm trying to explain, I will do the video for better understanding. Then for loan accounts too, this is it. We have mentioned that he borrowed loan, he repaid the loan and the likes, and we have entered, you know, all the transaction. You've written it out that, okay, this is what I want to debit, this is what I want to credit. And it's very simple. The first thing is knowing the two accounts that is involved. Which one am I going to debit? Which one am I going to credit? Then once you open your TAFE format, the debit, the left side is debit, the credit side, the right side is credit, right? Then just put it like that. If the two account is involved, for this one now, the first one we say capital and cash. So this is cash account. Then in cash account, you just put capital as your details. Then you put the amount. Then in our, I'm just trying to recap. In our capital account, you say you credit your capital account, then you put cash, then 30,000. So how do we balance this thing? Let me use capital account first because it is only one transaction that we have. So for capital accounts now, this is the year end. We are done with transaction. You don't have, before you can close your account, you know that, okay, you don't have any transaction that you want to impute or that you want to post again. So all these things that we've been doing since morning, that okay, debit this one, debit cash account, credit capital account, is called posting. So you are posting it towards various ledger, because you said that all these things now, all this is the ledger account, capital account, ledger account, purchases account, all these things, all these three formats, they are called ledger accounts. So now we want to balance our odds, we want to close our account. That is the next step. My network, please, can we hear me?
Yes,
we
I
can hear
can
you.
hear you.
Yes.
Okay, thank
Yes,
you.
you can.
Thank you. So now I said that we are done entering all our transactions. So the next step after entering all your transaction is what? Balancing your, I guess it's your network, Oluwasegun. So you can just okay, yeah, I understand you. So I guess so. The next step is after entering all the transactions, and I've told you that it's not that you will be opening like 4 5 purchases accounts, 4 10 cash account. This is just one. It's just that when you now have another transaction, you go back to that cash account and impute the. So like this one, they sell. There is a sales in this case now. So let me just set an example of what I'm trying to say. So Adeyemi sells inventory. So this transaction 6 now. Did you see that Adeyemi sells inventory of for 12,000, right? I said that will credit what? We credit sales and debit cash. So let's go. This is it. See the sales here. We debit our cash. This is our cash account. This is our cash account here, right? So I don't that I've forgotten to have show you guys this one, but I don't know how to split my screen. Then I forgot. So this is this thing that we enter in. This is that I did not open another different cash account for this one. So it's still the same. I enter the capital, the first capital, the loan that I received, the van that I bought, the sales now. So I'll just go to my sales account. I'll still do the video as you requested. See the 12,000 naira here. Then the receivables that the other time too is there. So it is just you have various distinct transactions for just one account. You be putting it in that one account, not you opening different accounts. So let's just balance up our accounts. That's what we want to do now. Closing up of accounts or balancing up of accounts when you are done entering all your transactions. So there are terms that we used to use. Now in accounting, you used to call something balance carry down. That balance carry down, this is it. Before you see that, what is balance CD now? So this thing that I highlighted, it is what let me use another color. Yes. So this thing I highlighted is balance carry down. So that is how we used to write it in accounting, balance carried down. So balance CD, we used to call it balance CD. Then the second one is balance carried down. So balance BD. Then in subsequent, okay, let me after this one, then I will explain that one. So this is before I enter this one. Let me delete it. This is what you will have now. I don't know, maybe you are following. So this is what we enter. This is the only transaction we have. So now this is our capital. You see the capital accounts now is only one. It is only the cash that I introduced that we have in the transaction. If we check the transaction, they didn't mention anything related to capital again. So Adeyemi introduced 30,000 naira worth cash as capital. So where is the capital account that we have entered? This is it. So this is the cash here now. So let us balance this capital accounts now. So as an accountant, this is the only transaction you have. How are you going to balance this thing? This one is just simple. Is you going and you know that we said that the principle of double entry is that your debit side must be equal to your credit side. So for our ledger account, how are we going to make this thing possible? So is you using what? Balancing up your account. So you write to balance, for you to balance your account. So you write balance, then C/D, balance carried down. Balance carried down. Don't mind my word though. That's the issue of using word. So balance carried down. So what is the amount of balance carried down? It's because you don't have any other transaction now. So I'll still use another account to explain. So what is the transaction? So that is the only amount we have is what? 30,000. You can't see my screen. Is it that it's small? Please, can you see my screen? Can you see what I'm doing?
Yes.
Okay, thank you. Please, you can just enlarge it. I don't know, you can put your screen forward. Yeah. So this is the 30,000 now. So 30,000 here. So this I said that this 30,000 word is what we call it balance CD now. So in accounting, then you do double line in your book. Oh, you do double line. I don't know, you can just Control B, you bold it in your book. You do double line as I've done it here because I minimize my distance. I can't say it. So you just balance it up. To close your account, you write double line under any you are balancing, like I've done in this one here. I'll demonstrate it in the video. So that is balance CD now. You closing your account means balance CD. It means meaning that debit side is 30,000, credit side is 30,000. That is what you have closed your account. But you have to let us know something that Okay, oh, this is the remaining balance in this account. This account now, as at the end of the year, we have 30,000 naira at the beginning, and at the end it's still 30,000 naira. So you now write what balance brought forward, balance brought down. So at the end of this year, the balance brought down, that's balance slash BD, is still 30,000 naira. Is that 30? Yes. So it's still 30,000 naira. Is it clear? Can I continue? Did we get it? Yes, thank you. Thank you. Okay, so let's use these purchases now. Let me clear the this thing I have done the purchases. Yeah. So bring out your calculator, we'll do it together. It's my delete function. Delete. Yeah. So if we check what you have entered, this is what we have on the purchases account. I will do one video to explain this. Then once I send the video, I will send the exercise before Tuesday that everybody will work to submit. Excuse me. So now this is our purchases account. Based on how we are debiting this, we are crediting this. So this is our purchases account. How do we balance up this account now? The first thing you are going to do is, what is the total of the debit side? Assuming we are using a zero now, it will have been simple. So what is 18,000 plus 25 will give us what? Please let's type it.
18,500. 18,500.
That's 25. Thank you. 20,500. It's 20,500. And note that the credit side is giving us what? 2,000, right? Are we together?
Yes.
Debit side is giving us 20,000. The total of the debit side is 20,000. Yes. Then this credit side is giving us what? 2,000. See, the total balance of this one is what? 20,000, 2,000. So what is the difference? So the difference between the two balance, between the two sides is what? It's called balance carried down. Balance carry. How did you get 18,500, Mr. Sheung? Where did you get your 18,500 from? I said the total balance for debit side, 18 plus 25 will be 20,500. So for the credit side, the only transaction there is 2,000. So now, meaning our debit side is not equal to our credit side. So to make the two side equal, that's why we used to use our what? Balance carry down. But in the case of capital accounts, it is only one transaction. So you just put the balance carry down as the only amount that you have on the account if it is only single transaction. But in the case of purchases accounts now, we have like three transactions. There's three transactions. You have two on the debit, you have one on the credit. And when we sum up the transaction on the debit side, it is greater than the transaction on the credit side. So how do we make our account equal to each other? Because the principle of double entry states that debit side must be what equals to credit side. So that is why we have to we use what balance carry down. Then your balance carry down means what? The difference between the two sides. The difference between the two sides. Now the difference between debit side and credit side is what? The total of debit side is what? 20,000. That is why I dark it. I darken it because this is the total. 18. Is it 18,500? Yeah. Thank you. Okay, I guess that is what Mr. Sharon is trying to say the other time. So 18,500. So the difference between the two is what? 18,500. So he puts it. So the difference between the two sides is what? 18,500. Then the sum total of this one too will now be what? 20,500. 500. Is it clear, everyone? Is it clear?
Yes.
Yes.
Thank you. Yeah, so at the end of the financial year now, the two side is balanced. So what you are going to let us know that, okay, after the end of the year, what is remaining in our purchases account is what? 18,500, right? Did we get it? The total of this, the total of both sides is 20,500. But believe me, what is the balance? What is the difference between the two sides? So you are going to bring it to this place as well. Balance carried down. This balance carried down. This is the balance carried down of purchases. So that means what our purchases is remaining. Come here, I'll explain that. So you just 18,500. So you bring the 18,500 to this other side here that is greater. So what this one is trying to, I'm coming, I will explain. Let me explain, then if you still have questions. So I said that the debit side is greater than the credit side, and the balance, the difference between the two is what? 18,500. Then we know that, so after we put the 18,500, where this side will be equal to this side, fine, our account has balanced. But then as an accountant, you have to let us know that this balance, this difference means that in our purchases, we bought an item of what? Of 20,500. That is what we bought. But the owner of the what? The owner of the business now draw. You remember that he withdrew what? Inventory, not cash. He drew inventory, took out inventory of what? 2,000. That is why our purchases, what? Our purchases account reduced. So they purchased everything we bought during the year. Our inventory, the inventory we bought during the year, sum up to 20,500. But the owner of the what? The owner of the business took inventory worth of what? 2,000. Took inventory worth of what? 2,000. So that is why what? My goodness, sorry. So that is why our purchase account reduced from 20,000 to what? 18,000. So you have to let us know that, okay, after the year end, what is the amount remaining? Okay, we know that the total is 20,500. But what is the remaining? What is the amount that is remaining in this account? So the amount remaining in this account is what? The total purchase after the year end is what? The remaining balance, not total purchase. The total amount remaining is 18,500. So, Mr. Alaminde, did you still have question?
Yes.
Okay, Mr. Alaminde, you can ask. Okay.
Okay. My question is, I want to know the difference between this C/D and B/D, because you call
You
them
can write it and I
balance
have
box.
explained. Yes,
You
I have
said?
explained. I said it when I wanted to
But
use
I
it.
was hearing you
I said
calling it the same
balance.
thing.
Okay, let me explain. I said balance carried, balance CD. That is this one. Balance CD means balance carried down. Yes, thank you, Prosper. Balance carried down. Then the balance BD means balance brought down. Balance carried down is telling us the difference between the two sides. So the balance carried down, this is balance CD now. This one is telling us the difference. If there's no difference, so the what is here, you just put it here. Like the capital account now, the difference between the two sides is still 30,000, because credit side is having 30,000 naira and debit side is having zero balance. So the difference is still 30,000. So you put the 30,000 naira as your what? Balance carried down. So, and I said that at the end of the year, you will still tell us that, okay, this is the amount after all the transaction, after all the plus and minus that we have done, this is the amount that we still have on the face of this account. It's still 30,000 naira, the balance, not the total. This one is just telling us that this is the total, the sum of this side is 30,000, the sum of this side is 30,000. But balance BD is telling us that I'm sorry, hold on first. So balance BD is telling us that the balance on the face of the account. This one that I darken is just telling us the sum of each side. So for this one now, this purchases account will help us to explain what balance CD very well, the difference between the two sides. And the funny part about accounting is it's still the balance CD that you are still going to bring to this side, the side that has the highest figure. If you assuming see now for capital now, see our balance CD is on the debit side, then we bring our balance BD back to the credit side here, that this is the amount remaining, and the balance is showing that the balance on this account is what is a credit what it is a credit balance. Excuse me, sorry, excuse me. So so this one now, this capital account now, the balance BD is on the credit side, right? It's telling us that credit side is greater than debit side, and the balance is what 30,000. It's showing that our capital account has what a credit balance, and we know that capital account is what is a credit balance. If our capital account has a debit balance, is telling us that something is wrong, that the business might liquidate anytime soon, might go down anytime soon. Then for our purchases account, this account is telling us that our debit side is greater than what our credit side. And what is the balance? What is the difference? That is balance CD 18,500. Then you have to let us know, okay, when you sum everything together, 20,000, the sum of everything during the year, the transaction you carried out on purchases account is 20,500. But what is the balance of this account? Is what 18,500. So it's telling us that our purchases account is having what a debit balance of what 18,500. And you know that purchases account is what is an expenses account, right? And it must have what a debit balance, and it has a debit balance of what 18,500. And one thing unique about balance BD and balance CD is that just balance BD is the one you can jot it down because you are going to use it next week. Your balance BD is the one that will go to your trial balance, because this one thing about accounting is from this ledger now we go to you take anything in this ledger, your balance BD, you take it to trial balance. From trial balance we prepare our profit or loss. From profit or loss we prepare our financial statements, like everybody used to see online, financial statement, right? But where do we start from? We are building our accounts from ledger. Say I don't know, maybe it's clear. If we don't understand, please let me know. Let me take water first. Are we clear?
Yes, yes.
Yeah, thank you. So let's let somebody, okay, let's do, thank you. Let's just do this cash accounts, and then okay, I will not do cash accounts. I would like everybody to work on this account. I will do the video and send it to the class page, and I will send the assignments that we are going to do. You submit before Tuesday. So now, okay, this fund account is also okay. So this,
I hope you share this schedule with us.
yes, I will.
This work.
So let's just do this loan account, then we call it a day. Okay, yeah. So where will our balance CD be now? This is our loan account. You are doing loan accounts. Please let's talk or you type. I'm waiting now. This is loan account now.
Our
There's
balance sheet will be on debit side. Debit side.
debit side. Okay,
Yeah,
balance.
balance CD.
Yeah. Balance CD of how much?
30,000.
30,000.
Okay, thank you. So the sum total will now be 40K, right?
30,000 naira.
I should have used Excel, but it's not giving me what I actually want. Mrs. Blessing, why is it 30? Why did you say credit? So this one too. Let me just copy and paste it back. So the sum total is 40. We all agree to that. Control B. You have to, and I said that you will see it in the video. You have to put double line below the sum total. It shows that you have closed the account. It shows that you have closed the account. When you put this figure now, you put 2 line below it. It shows that this account, I have closed it. So this one that I darken it now means that I have closed. This is the sum total. I have closed this account. Now, where will my balance BDB? Which side will my balance BDB? And how much is my
On the
balance
credit
BDB?
side. Okay.
How much?
30,000.
30,000.
30,000.
Yeah, thank you so much. So this one is telling us that our loan account has at the year end, the sum total, all the transactions that happened during the year is 40K, the total sum, but then the balance, what is it remaining, is 30K. So loan account has what? A balance of what? 30K. So, and I said that it is balance BD we are going to carry to our trial balance account. So when posting to, and one thing about trial balance, I'm just giving us the summary of like a gist of what we are going to be doing next class, is that for your trial balance account, this is the loan account now. When you get to trial balance account, it's the simplest. You just carry this loan, you just write loan account, then there will be 2 columns, debit and credit. So your loan account is having what? Credit balance. I said this balance BD now, this is credit 30,000 and it's on credit side. Means that our loan account is having a credit balance of what? 30,000. Just go to your trial balance, write loan account, then you put it under our credit side. You see where you write your credit, then you put 30,000 under credit, meaning that 30,000. Then for the one we did the other time, our purchases has a debit balance of 18,500. Then in trial balance, you just write purchases account 18,500 debit side. So simple. So do you have any question before we call it a day? Is there a question?
No.
Please don't
No.
forget to share this with us.
I
Please.
will. All right, thank you so much. We'll call it a day. I will send the video and this material before tomorrow morning or tomorrow. All right. Please, let's just
Thank you.
check, just go through what we've done today so that next week it will be easy for all of us and it will be fast. All right. All right. Now, good night, everyone. Ensure you read, ensure you revise. Right. Good night.
Good night, ma'am.
Thank you. Good night.